Hello, everybody. This is Ben and Tchaikovsky. Welcome. We're going to do another video here, continuing on earnings per share. And this kind of leads up to the discussion of also talking about stock options and as well as stock compensation expense. So my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself only and not my employers or affiliated organizations, including but not limited to Irvine Valley College in the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. The presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information as the copyright of other parties. I do not claim any right to the copyright that I'm referencing in those parties. So the first thing is that stock options are kind of a part of, for most companies, when you're incentivizing employees, you're going to essentially incentivize them with a base compensation. Then you're going to incentivize them probably with a bonus. And then possibly if you're looking for them to be more involved is to give them ownership rights, basically in the form of stock. Now, there's a lot of different ways you can do this. There's like phantom stock, there's not the phantom menace, but there's phantom stock. But when options are given, what we have to go through and use is that you have to essentially kind of go through and do a calculation, which is using something called Black-Scholes. And essentially what Black-Scholes does is that you put in the spot price, strike price, current price, when maturity is, the risk-free rate, which is oftentimes correlates to what you would receive on a Treasury bill, volatility index, and that's going to be a lot based on the stock volume. And then if there is in fact a dividend, and that will kind of show that's going to kind of give you how you go through and essentially compute that option. So once you kind of figure that out, you're going to essentially say, okay, the value of this option over the vesting period is X. And we're going to go ahead and take that amount and then divide it by the number of years. It can be done straight line. However, if you have a vesting schedule that is uneven, the stock compensation expense should be recognized using the grading method. What does that mean? If 10% vests in year one, then you basically recognize that 10%. So what we're going to do is we're going to take the options being granted. We're going to then go to the Black-Scholes, and then we're going to go ahead and record stock compensation expense. Now, what's really important here is when we look at this, are we crediting a liability? And the answer is no, because we're essentially giving our employees stock. But instead, we're crediting something called additional paid-in capital. We're actually probably additional paid-in capital. This would really be stock options, but it's just going to go to additional paid-in capital. And the thing I want you to really, and where a lot of investors don't like this, is that because this kind of like this expense isn't really real. And in some ways it can be because you got to recognize the comp, but in some ways it's not. But if I want to show you an example here of Twitter, right? So this is the company formerly known as Twitter. And the thing I want you to look at first is to see that, wait a second, right over here, this company is operating at a net loss of $456 million. It's operating at a net loss of 521 million, and then it was operating at a loss of 577 million. It's like, oh boy, is it the end of the world as we know it? And the answer to that is I don't know. But what caused this loss? And if I come over here, and this is why the statement of cash flows is so important. If I go through here and I look at my stock-based compensation expense, because remember, this is like depreciation, it's a non-cash charge. When I go through here and I'm making this entry, this is a non-cash charge. So what happens is when I do my statement of cash flows, this is going to be an add back, and voila. If I added this back in Twitter, if we just completely disregarded this, all of a sudden now I'm profitable for effectively 2014, 2015, and 2016. Kind of go figure. But that's why it's really important that you recognize that there's a lot of things in financial accounting that don't really seem, in my opinion, don't really seem to make sense from a business perspective. And this is one is that it shouldn't be in there. It's not really an expense, in my opinion. The also same thing can also be said for leases, but again, you have to do it. You have to record it. It just, I'm making you aware of that because a lot of times investors will add those amounts back. So, and just some other kind of things here is that when it comes to stock options, if the employee leaves before vesting, you adjust the compensation in that time period. We don't go back and make retroactive adjustments. Even if the unvested options are forfeited, and if the options are exercised, you basically show the cash received and the stock that's being issued. Now, in terms of other parts about stock options, right, it's a right to purchase any stock at a specified price. You've got the strike price, where you can buy at market price as the current trading price of the stock. In the money, strike, that basically means when strike price is below the market price, and then out of the money. Strike price is above the market price. And remember, your impact on earnings per share is it only affects the denominator. So when we go through and compute the dilutive impact of stock options, the first question we have to ask is that, are the options in the money? If the options are in the money, fantastic. If they are out of the money, we're going to go ahead and disregard it. But when we disregard anything that is considered to be anti-dilutive, right? Whenever you have something anti-dilutive, what we're going to basically go through and do is we're essentially we'll exclude it from the earnings per share calculation, but we want to make sure that we go through and we want to make sure that we're going through and disclosing it, right? The disclosure is key. And the one other thing I would like to mention to you is that if you are working as a CFO, one of the things that you'll be doing is what investors will be asking from you is they're going to ask for you for something called a capitalization table. What does that mean? It basically means that you've got your common stock, but then what are all the other instruments in the form of warrants, options, whatever might be out there, convertible bonds, whatever might be out there, convertible notes. What other things out there can potentially convert preferred? What can potentially convert into common stock? Why is the capitalization so important for an investor? Because the investor wants to know, hey, how is my ownership going to be diluted? If I think I'm buying 5% of something, I want to be buying 5% of something, right? If there's all these dilutive securities out there, I may end up owning, instead of 5%, I may end up owning 1%. So it's just something to kind of go through and to think about. So other kind of things over here, and again, these are always going to be the most dilutive security, because when we look at the numerator of earnings per share, right, under diluted earnings per share, you've got net income minus preferred dividends plus interest expense. And what exactly does that mean? Well, if I have convertible bonds, where we basically assume that they've been converted, I'm going to have to go through and add those back. So there's nothing being added to the numerator. We only have potential dilutive shares being added to the denominator. So let's go ahead now and come over here. And so what we're going to go ahead and do, there's a couple ways we can do this. We can basically take if they exercise the options, we basically say, how much would they get in terms of if they turn around and sold them, but then what would it cost them to buy? What's their profit? And then once I take that profit and divide it by the market price per share, that's going to tell me the new shares to be issued. So we're now going to go ahead and take a look at this question right over here, question 1.9. So let's jump into this right here. Okay, so we've got over here Balboa Corporation reported the following information for the year ended December 31st, 2032. Basically here have net income, weighted average shares outstanding, average market price of the common stock. There are no preferred dividends. The company has no other potential dilutive securities. Determine whether each tranche of stock in the money is in the money or out of the money. Compute basic earnings per share, apply the Treasury stock method to the options that qualify, compute diluted earnings per share, and why this is not done. What do we do with this excluded tranche of shares? So first thing to do is which ones are in the money and which ones are out of the money. The best way to look at this is to say, well, would I exercise these 80,000 options at $40 per share? And the answer to that is absolutely not, right? Because these are going to be, why would I go out and buy these if I can buy shares at $30 per share? So this will be excluded from the diluted EPS computation. However, I'm going to include tranche 2 in the disclosures. So I'm going to, this part E is that, it's not being included in diluted earnings per share, but I will include it in the disclosures. Okay. Now, which ones are in the money? This is going to be in the money. So we will compute, basically we'll include in our diluted. Okay. Now, compute basic earnings per share for 2032. There's no preferred shares. Basic earnings per share is going to be my net income minus my preferred dividends, which are R none, divided by the weighted average shares outstanding. Okay, so this is going to be 3.6 million. So my basic earnings per share is at $4.50. Okay, now we know that over here, apply the Treasury stock method to the options that qualify for inclusion in the earnings per share. So let's make this easy. If I sell 40,000 shares per market at market, okay, this is going to be 40,000 times 30, or 1.2 million. Okay, now if I sold them, those shares are not free. Okay, so over here, the cost of these 40 shares, excuse me, so this is 40 shares at 30, which is the market price. Okay, so, but these shares are not free. For me to exercise, I've got to spend $18 per share. So 40 shares at $18 cost per share. Okay, so right over here, this is going to be 40,000 times 18, or 720,000. So now my profit is going to be 480,000. Okay, so this is how much money I'm making. So what I want to do now is to see, well, how much is this going to be in terms of basically in terms of a dilutive nature, is I want to take that profit and I want to go through and divide it by the market price per share. And my market price per share is at $30 per share. So here, this is essentially going to be going through and adding 16,000 shares to my weighted average diluted. Okay, so that's how we're kind of going to go through and do this, and just give me one moment. Okay, so my diluted earnings per share, right? My net income is not changing. My net income's still here. Let me just move this down. Okay, so my net income is still going to be 3.6 million. However, basically my weighted average shares outstanding plus my options coming out. So this is going to be 800,000 plus 16,000, or a total of 816,000. So here, my diluted earnings per share is going to be $4.41. This, whenever you have options that are in the money, they will always be dilutive. Okay, so, and we would also be going through and disclosing this in the footnotes and the financial statements in terms of how we're going through and computing our diluted earnings per share. I'm just going to pause one moment real quick. So here's going back to our Twitter example of like the following table presents the calculation of both basic and diluted loss per share for the periods presented. Okay, so the following number, so you see this right over here, the following number of potential common shares at the end of each period were excluded because the effect would have been anti-dilutive. So what that means is that if you're at a loss, we don't throw in, we're done. Everything's anti-dilutive at that point. So here you can kind of see restricted stock units, warrants, stock options, shares subject to repurchase for each of these different periods, right? So over here, this is how you can it has to go through and be disclosed. Okay, so let's go back over here. Okay, so I think that takes us over here to question 1.9, which is going to bring us to the end of this presentation. So I want to thank you for watching. Please remember to like and subscribe, and I look forward to seeing you on the next video. Have a great day.